Welcome everyone. My name is Nikki Johnston and I'm with Transition Advisors. Our webinar today is Valuing Accounting Firms. Before we begin, we need to cover just a few important items. First, please close any other programs that you have running on your computer. This will just help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order to receive the 1.2 credits, you must complete two requirements. The first is that you participate in all 4 of today's polling questions. And please note that GoToWebinar does monitor your participation in these polls. We'll be able to give partial credit for those of you who answer 3 out of the 4 polls. That will qualify for 1 CPE. Next, you must also complete an online evaluation. This will pop up immediately after the session ends, so please take a moment before you close your browser to complete that survey. Once you've met both requirements, you will receive your CPE certificate by email from me within 10 business days. Now, in order to fully participate in the webinar, please take just a moment to look at that GoToWebinar control panel. It should be on the right-hand side of your screen. There's a little orange arrow near the top. You can use that to minimize the panel if you wish. During the presentation, all participants are muted, but you can communicate with us by using the question box. Toward the bottom of the panel, you'll just type your question in and click send. If Joel doesn't have time to answer the questions today during the session, we'll be sure to get answers to you via email afterwards. Now today, Joel will also be sharing his webcam in addition to his slides. You can resize either or both of these windows, and if the webcam is distracting or you'd rather not use it, there's a little X there that you can always exit out. I'd also like to remind you that we have a CPE webinar each month. We just added the following summer dates. They're up on our website if you'd like to register. On June 8th, we'll do a session on ownership agreements. Then at the end of July, on the 27th, we have a succession planning and alternative deal structure webinar. And then August 17th will be growing your firm through M&A. Again, you can register for any of those on our website, transitionadvisors.com. And now before I turn it over to Joel, we'll go ahead and do the first of today's 4 polling questions. So this first question is, how many equity partners do you have in your firm? And I'll give everyone just a few moments to give us their answers. It's always helpful for Joel to know what kind of audience we have today. And again, this is the first of 4. You do have to do all 4 to get the 1.2 CPE, and if you answer 3 out of the 4, then you'll qualify for 1 CPE credit. Okay, that's nearly everyone, so I'll go ahead and close the poll, show the results there. 60% have 1 equity partner, and then 37% are in that 2 to 4 range. 3% are in the 5 to 9 range. All right, so now I'm going to go ahead and turn it over to Joel. Joel Sinkin is the President of Transition Advisors. Thank you all so much for attending, and I hope you enjoy the webinar.
Okay, my webcam just disappeared. Isn't that interesting? There we go, we found it. Whoa, sorry about that, everybody. But hi, I'm Joel Sinkin. I'm the President of Transition Advisors. And we're going to talk today about how to value an accounting firm. Based on our audience size, most of you are small 1 to 4 partner firms. We're going to spend most of our time focusing on the smaller firm. However, we will spend some time discussing things about how to not only value a practice when selling externally, but how to value a practice when selling to your partners. I'm not going to turn this into an infomercial, which we never do. To us, a CPE is kind of sacred from an educational perspective. But I do believe it's important to understand the background and culture and things where the speaker is coming from. Since 1990, the only thing I've done is help CPA firms with growth and succession strategies through mergers and acquisition. Been involved in over 800 closings of accounting firms, ranging from top 100 deals to sole practitioners. Made a lot of mistakes, seen a lot of mistakes, but try to not make the same mistake twice. So after a lot of years of making them, hopefully we're going to help you avoid the same issues and roadblocks and get you to the promised land. It's very challenging when you value an accounting firm, because if there's 50 things most people need to know about doing that, The smartest person in the room thinks of 35. And every practice is so unique. If I took 5 firms that had the same amount of revenue, partners, and staff, there may be nothing else similar about those firms. So today, there may be 50 things you got to know. We'll get you into the 40s, but hopefully common sense will get you the rest of the way. You know, I happen to write for the Accounting Today, Journal of Accountancy, CPA Journal, quite a few magazines, and I get them and read them. And there isn't one of those magazines or publications that come out that don't spend some time talking about recent mergers and acquisitions. The activity is amazingly high. Each year for the last 4 or 5 years, it's been a new record set, the amount of deals that have gone down. There's a lot of reasons for that. You know, in 2006 through 2008, we were in a very different world. We were growing organically like a weed. Staffing wasn't the nightmare it is today. And the M&A activity was a little bit less because people were successful in their growth. 2009, the economy really started to go down for most of us. As a result, M&A started to increase again. The reason for that is when organic growth starts to become challenged, as a matter of fact, just staying the same with attrition was challenging, suddenly merger and acquisition growth tends to become more interesting. And here we are in 2017, and as I said, each year for the last 5 years, we've had more closings in the history of any other year. There's additional factors that come into play here. One of them is niche development. You know, 25 years ago, there were very few firms that were doing wealth management, business valuation, HR departments, IT departments, very, very different than now. Many firms are trying to add, even get away from the type 1 accounting and tax services to get to the value added, the most trusted business advisor. Niche development has impacted M&A greatly. People that want to add a niche through a merger or acquisition, or to create cross-selling opportunities. For example, maybe I have a voluminous amount of law firms as clients. Maybe you have an expertise in business valuation and litigation support. We merge together, there's automatic cross-selling opportunities, as you could see. IT has changed things around as well. The reason I say IT has changed things around as well is because of the fact that having a satellite office is much easier to do now because of the fact that technology makes 2 offices one. For example, we recently had a firm in Washington buy a practice in Florida. When you call the 954 area code in Florida, it rings in Washington. So there were synergies that we were able to create even though we were in separate offices. I see my webcams giving us heart. I don't know why. I apologize. But the biggest factor that's involved in M&A is the aging of the profession and the advent of the baby boomers. The boomers make up a significant percentage of the clients right now that are involved in mergers and acquisitions. And let's take a look at some of the demographics to get our arms around that type of thing. Look at all the firms on the top, on the large firms that are making partner buyouts. Almost 85% of the larger firms. Even the smaller firms, 25% of them are right now in the middle of buying out partners. And this is just at the beginning of the curve of the baby boomers. It gets even more profound. For example, look at all the different firms here listed that have different issues and how many people are starting to think about succession. Most of you are smaller firms with less than 15 employees. 70% of them don't even have a succession plan in place. Yet the majority of them, over 65% of sole practitioners, will be eligible for Social Security within 5 to 6 years from right now. They're all not planning to leave that quickly necessarily, but it certainly tells us something about it. Look at the percentage of people that have recognized that succession's an issue. I don't want to read lines to people very competent of reading, and I could show you more and more and more demographics, all telling us the same thing. What's compounding this issue, however, is the staffing issue. See, here we are facing the greatest exodus of talent we've had. The partners that developed and built practices, some of the best rainmakers in the firm. And as we're losing them, we have the lowest percentage of partner-ready talent available to step up. It's a daunting task. If we didn't have the staffing issue, our succession issues would clearly be much less. And this brings us to the first thought I wanted to share with everybody, and that is understanding, is it a buyer or a seller's marketplace? The answer is never as simple as the question, but let's look into it. If you're a small practitioner in a densely populated part of the country, I will tell you that you're probably in a pretty good seller's marketplace. Values have come down. 25 years ago, I saw 2 times. Just 5-7 years ago, I saw 1.5. Those numbers are pretty much history these days for 95 to 99% of the deals out there. But it's still a seller's marketplace in those areas. I'm speaking to you today from Long Island, New York. I know I sounded like I was from South Carolina, but I was just fooling you all. But in Nassau County, New York, there's 3,200 CPA firms, more than in Manhattan. There's more accountants in Manhattan, not CPA firms. If I had a $500,000 practice in Nassau County, there are hundreds of firms that are large enough to absorb me into their practice with no incremental increases in overhead. As a result, Long Island still gets a pretty good premium for their practices. If I'm 2 hours outside of Boise, Idaho, I might be in some of the most beautiful country there is, but there may be one accounting firm for every couple of zip codes in some of those areas. Supply and demand changes things. As a result of that change, it's very much a buyer's marketplace in that area. So the size of your firm, if it's small and you're in a densely populated part of the country, you're in better shape than if you're in an area that's very sparse. The other place that's really been impacted is revenue, big firm revenues. What I mean by that is, let's look at an area like Boston. Boston has approximately 43 firms doing between $3 and $10 million in revenue. They have 3 or 4 firms that are local regional firms that are big enough to take on that big of a practice. And if you have 43 firms in that range in Boston, I'll bet at least 50% of them, probably 2/3 to 3/4, but clearly at least 50% of them, lack the internal bench strength to execute a succession plan. So a lot of these firms are looking at merging up right now, yet at the same time, there's only 3 or 4 firms big enough to take them on. So those 3 or 4 firms are very much in a buyer's marketplace. They have a choice of who to take on. And to show you how different things are, we had a top 100 firm recently come to us who wasn't in Boston area, but wanted a New England presence. And interestingly, they said to me, and interesting on a couple levels, but they said, we're looking for an $8 to $10 million firm. They said, but let's say you had 2 of them. And one had great metrics, everything about the billing rates, realization were great, but they were woefully behind in technology. The other firm was on the cloud. The other firm had a lot of things, good things going. They've embraced technology. They're paperless, multiple screens, but their metrics were a little weak. They said, I'll take the one with the better technology. I was shocked. I asked why. They said it took them 10 years to get their partners and staff to throw out the paper. They weren't going to take a step backwards in culture, but they could make someone's metrics better. I said, that's amazing. They said, the other reason that we could do it is because we can. There's so many firms that are now looking for a succession solution that we have our choice. So we might as well stick with who we feel the most comfortable with. So things are changing. It's becoming more and more of a buyer's marketplace in most of the country, unless you're that small firm in a densely populated part of the country. Yet, even in those small firms in densely populated part of the country are getting a lower valuation. What saves a lot of us who are hoping to have a market for our practice is that at the end of the day, there's still only 3 ways to grow an accounting firm. One is client at a time, which in a good economy can work. A bad economy, maybe it makes up for attrition. Adding a marketable niche to cross-sell, obviously a very popular way of doing it. But the fastest way to grow still remains a merger or acquisition. Let's take a break and make sure you get your CPE credit today, and let's do our next polling question. What issues do you see affecting your practice most in the next year? Succession. Number 2, admitting new partners. Number 3, client retention. Number 4, need for growth. Number 5, all the above.
Great, thanks, Joel. So those options are all on your screen now. Just select the one that is most relevant to you. We'll give everyone about 20 more seconds to finish this poll. Got nearly everyone voting, so I'll go ahead and close it and then share the results there on the screen. So 38% indicated succession, 26% said a need for growth, 23% all of the above, and then the last 2 options split there, 5% and 8% respectively.
Well, very indicative of the demographics of our marketplace. But let me say this about the people that are looking for both. Sometimes that confuses someone. I was teaching a CPE class just yesterday, and a whole bunch of firms answered the same way, that we need both. And those that said I either was a buyer or a seller didn't get it. Here's why. There are many, many firms that, for example, are 6 partners. 1 might be looking at an immediate sale. 2 might be looking to slow down over the next 3 or 4 years. The other 3 are all young people that want to work 10, 20 more years, but lack the capacity to replace the senior partners. So in that type of situation, as many people who responded today are in, therefore you're in a position that you have some partners seeking succession and some partners seeking growth. This brings us to how to value an accounting firm, and I always jokingly say, but it happens to be the truth. Whenever I teach a class on how to value an accounting firm, there's always 3 questions that people come up with. The first one is, what is the multiple? The second one is, what is the multiple? And the third one is, guess what? What is the multiple? What I try and get everybody to understand is valuing a practice comes from a perspective of multiple variables and how they interrelate with each other. We're going to focus on the 5 main variables that we look at when valuing an accounting firm. If you're one of the 3 people that bought one of the books we wrote that talked about how to value a practice, and I said there were 9 variables, I was paid by the page, forgive me, 5 will work. In no particular order, the first variable we're going to discuss is cash up front, if any. I will tell you the trend in most situations in 2017, mirroring 2016, is little to no money up front. It's very, very rare that someone's writing a big fat check at the onset of an acquisition. Very, very rare. And if they're doing a 2-stage deal, if you're familiar with a 2-stage deal, there's almost never a down payment. And if there is, it's at the onset of stage 2 when the buyout starts. Stage 1 is a merger period. But those that do come up with cash up front, let me give you the range is really 0 to 20%. I have more at 0 than at 20%, I'd say 10% is a realistic target. The smaller the firm, the more likely you get a down payment. And when nobody acquires a $20 million firm, they acquire some partners, others exchange equity in their firm for the other firm. Rarely is there money transferred. Matter of fact, if anything, you're going to have to loan the firm your AR and WIP, let alone getting cash down. But cash down as a variable is impacted by several things, not just how deep my pocketbook is. For example, just last week, I got a call from a practitioner in the Midwest who said to me that that was their last tax season. Personally, I was saying to myself, shame on them that we didn't do a transition prior, but this is their goal. That was my last tax season, Joel. I said, tell me about your practice. Well, by now I've billed 80% of the revenue I billed for the year. I'm very tax season oriented. And then he went on to talk about how he wanted a strong down payment. I said to this gentleman, Michael, are you operating the practice cash flow positive or negative from June to February? He said, oh, negative. I said, and you want a down payment? So the time of year and the cash flow that can be expected has a lot to do with someone's ability or desire or willingness to come up with money up front. Treatment of accounts receivable. You know, if I have a $1 million firm and they have $250,000 in receivables and they expect the first dollars to come in to grow those receivables, I got to make up that $250,000. I'm going to need 3 months of operating capital to pay rent, labor, and everything while that receivables coming in. You want your own receivables, you're probably not going to get a down payment too. You give me a payout on your receivables, maybe 6 months, maybe 2 years, you probably can get a down payment. So there's a lot of different things that impact money up front. But keep in mind, it's just variable number 1. Variable number 2 is one of the most important ones to the successor firm. And that's the retention period or guarantee period, meaning how long after I sell you the practice, if the fees of the clients that I sold to you go up or down, does that impact the balance due the seller? Now remember, we're talking about an external sale here, not an internal one. We're going to talk about partners buying out partners, which is vastly different. There are three main categories that relate to a retention period. They are a limited guarantee deal, meaning at the end of the first or second year, the purchase price locks, and any changes thereafter no longer impact anything. The second one is a retention-laden deal, where the entire payout period is a retention period. That, for example, is what's also called an earn-out deal or a collection deal. So if you were getting the proverbial one time over 5 years, it'd be 20% of collections for 5 years. And very, very, very rare is the fixed deal where there's no retention period. I'll tell you, in over 800 closings of external firms, not the internal consulting jobs, I've been involved in one fixed valuation that had no retention periods. Very rare. What's counterintuitive is, what's the best deal for the buyer? What's the best deal for the seller? And we've been doing some research accordingly for an article we're drafting. Very counterintuitively, again, the worst deal for the seller was the 1 year retention period. Meaning whatever the buyer did in the first year locked the purchase price. And let me share with you what our research has told us. You know, one of the negatives of selling an accounting firm is your buyer is a CPA. And what I mean by that in a negative way is, most CPAs aren't the people that look at the cup and say it's going to grow, grow, grow. They say it's going to shrink. What's wrong? What's wrong? We're trained skeptics. That's what we're trained to do. So what happens is, when a seller says to a buyer, I want a 1 year guarantee, they envision Moses separating the Red Sea and taking away all the clients in month 13. So what does a buyer do? They reduce the offer they would have made to impute this greater risk factor. And if they're smart, they shake the client tree really hard during those first 12 months. You're not going to want to lose a client in month 13 that you could have lost in month 5. So what ended up happening was the seller got a lower valuation, a lower multiple from a buyer who was the least patient in the transition, and locked the purchase price at a very challenging moment when they've lost clients. Also, usually when you do a limited guarantee, most buyers will not allow special projects to be calculated. How can I pay you a multiple on something I may never get back again? Interestingly, in most situations, the best deal for the buyer was a 2 year retention period. The reason for that is, let's say Nikki buys my practice right now, and she does all the work in 2017 and the rest of 17 and 18. If those clients come back in 2019, year 2, after the tax season of next year, they're happy. See, the greatest risk of retention isn't year 1, it's year 2. Because year 1, you go through the change. Year 2, you said, hey, I'm okay with this change and I'm coming back. So therefore, what happened for buyers is, what was more likely after 2 years? Losing more clients in years 3, 4, and 5, or getting fee increases, special projects, new services providing to those clients? So what the buyer did was stop the seller from participating in these fee increases and special projects and locked it at a very safe period of time. The best deal for the seller, which was totally a surprise to many people, was the collection deal. You see, when the seller is getting paid 100% based on collections, buyers feel more comfortable. They feel less risk. They're prepared to offer a higher valuation for the practice. They're more patient in the client transition because they don't have a time frame that if they lose them after that, shame on you. So what actually happened was the sellers participated in special projects. They participated in fee increases. They got paid as much as 0.2 higher in the multiple. So very, very interesting that the duration of the retention period became such a powerful factor in influencing the valuation. The third variable, I think, is probably the least understood, even though in some people would think it's the simplest, and that's profitability. The reason I say it's misunderstood is because many people, based on our training as an accountant, is to look at profitability from the seller's perspective. However, I maintain that the seller's profitability is almost irrelevant in most accounting firm deals. Let me give you an example. Let's say I had a $300,000 practice. I was operating out of my home. My wife, Kathy, answered the phone and helped me out from a management perspective. What was my net? 85%? But then we were tired of people knocking on the door, coming to the house, so I took an office. Kathy didn't come with me. I hired an office manager. Now, all of a sudden, I also brought in a per diem because I wanted to spend a little bit more time relaxing. Now, my net was 40%. Same practice, but my net's half. At which point in time was it worth more to you? It's not relevant. See, if I can absorb your practice with no incremental increases in overhead, it's a very profitable transaction. If you tell me you want goodwill and I got to deduct it over 15 but pay you over 5, if you tell me I got to keep your location even though I have one a mile away, you tell me that I've got to keep your office manager, she's making 150 grand a year, 16 weeks paid vacation, but it's been with you for 40 years. These things do what? They mitigate my profit. The more profitable you structure the deal for the successor firm, the more they can afford to pay you and still generate a profit. The great mystery of billing rates is another category that people don't get. You know, we all focus on the seller's billing rate and we clap our hands and we say, okay, now we understand. We don't understand. Here's a great example. A couple of years ago, I had a $1 million firm. It was in Southeast Florida. It was owned by two partners who both were looking to slow down simultaneously, kind of rare. Usually the timing's not like that. Here's what made their practice unusual. They were the only two CPA professionals in the whole practice. The rest were all clericals and bookkeepers. They did 100% of the heavy lifting. I had a successor firm doing due diligence on them, and they called me up and said, Joe, we got a big problem with that Florida practice. I said, what is it? I said, the partners are only getting $200 an hour, and we get $300. I said, listen, your practice as the successor firm, partners, managers, seniors, juniors, they don't have any depth on the bench except for bookkeepers. I realize you need a partner to replace them to do the hand-holding and the client relationship. But you just did due diligence. Who's going to do the work? What level staff? They said, oh, well, we would move all that work to senior level. That would be leverage to our seniors. I said, what's your senior billing rate? They said, 150. I said, I guess they're getting 200 an hour now. So they looked at a piece of paper and said, that's the billing rate. That's not your billing rate. I lost a deal 4 years ago. 30% of the practice was audit. We subsequently found out that the audit partner was the only one who reviewed the papers. The successor firm had a much more robust quality control process and needed 2 pair of eyes to review all those things. Therefore, it would have taken us more time and effort to derive the fee and reduced the net billing rate, unless we could raise the fees, which we couldn't. So what you have to do isn't look at what their billing rate, or their profitability. You have to transpose it to what yours would be. It's also why very rarely is one of our deals done as a goodwill transaction. I realize why a seller would want goodwill. But unless you're getting a 15-year payout, the buyer is suffering from that tax consequence and is going to reduce the offer made to you by that problem. So in a way, it's still your problem. Many deals have some, if not all, allocated to consulting. So that this way, the entity that I hire, who's really the seller, continues to pay their car lease, medical insurance, feed their retirement programs, put all these things through the company. Yes, what comes out is taxed at a higher rate, but you have the use of pre-tax dollars, and you got a higher multiple. So variable number 1, cash up front, if any. Variable number 2, the duration of the retention period. Variable number 3, profitability of the transaction for the successor firm. Variable number 4, the duration of the payout period. I will tell you for most small firms, let's say under $1 million, 4 to 7 years is the typical range of payout periods, with the highest amount of them being 5 to 6. The larger the firm, not only traditionally the lower the multiple, but the longer the payout period. So a larger deal, including large firms' internal succession, which we'll be speaking about shortly, is typically more like a 10-year payout. So the 4th variable is the duration of the payout period. So we have our first 4. Number 5 is the multiple. But the multiple is the effect. You have to focus on the cause. Look at the basic rule we put out on your screen just now. The lower the down payment, the longer the payout period, the more profitably the deal is structured, the longer the retention period, the higher the multiple, and vice versa. Let me give you an example. let's suppose that all of you on the phone with us today and on the computer are buyers. You have capacity in space, you have capacity in talent. And you could absorb my practice with absolutely no incremental increases in overhead. Very profitable transaction for you. If I said to you, buy my practice and pay me 15% of gross collections for 10 years with no cash down, would you do that? It's 1.5 times. I haven't had a deal at 1.5 times in 2 or 3 years at least, I think. Yet as a consultant, I would tell the buyer to do that deal tomorrow. Yes, 1.5 times, but 15% for 10 years. It's the structure. Some of you will say, well, the reason for that is because there's no interest factor. And you're paying it over 10 years, so the present value of that is really not 1.5 times. I won't necessarily agree with you. There's a couple reasons for that. First one is, I understand present value, but I've never done well with present value. I mean, I get it, the interest and everything else, but it's always been a tough concept for me. But here's why. If that practice over 10 years goes from 300,000 to 400,000, that's better than any interest factor. And the seller's very often participating in that growth, because it's very hard to negotiate a deal with a seller that says, hey, if I lose this client, I'm not going to pay anymore. Oh, by the way, if the fee goes up, you don't get that either. Good deal's a fair deal. They're going to participate on the downside. They should participate on the upside. So it's the packaging that made that deal so wonderful. If I lost a client after 5 years, I collected 500% and only paid 0.75. If I raised the fees 5% a year for the first 3 years, I almost paid for the entire acquisition. I'd run to the altar to do that deal. Let's say now the same seller says, I want to be paid out in 5 years. Whatever you do in the second year locks the purchase price. And I want a third of it is goodwill, and I want 10% up front. Depending on where you are in this country, we're now looking at between 0.75 and a maximum of 1.25. Very few areas in the country would pay on those terms 1.25. Typically, you're looking at most of them between 80 cents on a dollar and 1 time. Same seller says, I want to be paid out in 4 years. I want it to be a goodwill transaction. Whatever you do in the first year locks the purchase price, and I want 20% up front. I couldn't get them 70 cents on the dollar anywhere in this country. That same seller said, I want all cash at closing. Me, I wouldn't do it for 50 cents on the dollar. So here's the exact same practice that I would run to the altar to do it 1.5 times and wouldn't touch at 0.5. So how do you start with multiple? Multiple's the effect. And I will tell you the biggest mistake in my mind that a lot of sellers and buyers do is they try and negotiate one variable at a time. You can't really negotiate one variable at a time because they all impact each other. That's why when we do evaluation, we talk about everything. How much money up front? How is it credited back? What's the tax ramifications of the deal? How are we handling new business? How are we treating AR? How are we treating WIP? All these things are part of the profitability, the package of the deal. I can't tell you how many times we'll get a call from someone, hey, Joel, I've met this firm on our own. We've already worked out everything. We just need someone to help us in drafting the agreement, planning the transition, and the integration. Can you help us? Sure. Tell me about the terms of the deal. They start telling me. Then I say to them, well, what's the tax treatment? Seller says, well, it's goodwill, isn't it? The buyer said, I didn't know it was goodwill. How are you handling AR? Well, we didn't discuss that. So the problem here is you think you found a multiple, but now if the tax ramifications are vastly different, it's going to impact that multiple. You got to look at it as a package. Now, sometimes when I taught this class, I'd have someone come up to me and say, how come you didn't talk about the valuation difference between a tax client and a traditional business client? Most CPA firms, not all, but most, place a lower value on a 1040 client than a traditional accounting firm client. I remember once having that question come up at the AICPA Practitioners Conference, which this year I'm speaking at again, is called Engage. And someone said to me that exactly that. Isn't a 1040 client worth less? Shouldn't it be a different pay scale? So I asked the room on a show of hands, on a pure collection basis, what do you do better, collecting in tax returns or business clients? Tax returns won by a lot. I said on a pure profitability, realization, billing rates, etc., what do you do better on? Tax returns or the business client? Oh, tax returns. On a liability and exposure basis, where do you have less of it, in the tax returns or the business? Oh, the tax returns. So then I'd say, why do you want to pay less for the tax returns? I got two answers. One was because it comes at a terrible time of year, during time of great compression. My response to them was, you chose to be a CPA, you knew that was the field, stop complaining, get over it, move on. But the other point was a very lucid point. They said that tax clients have a greater turnover ratio than business clients. We have a greater attrition factor with a 1040 client. Statistically, that happens to be 100% true. Is that a value issue? What it really is a retention issue that becomes a value issue. See, if I'm paying you 20% for 5 years and I lose someone and I don't pay for it anymore, it's hard to justify lowering the value on the 1040 clients versus the business clients, unless the billing rates and everything were very low. However, someone who has a practice filled with annual clients wants a 1-year retention period, meaning I have one visit to see that client once and have to make them mine in one visit. That's so riskful that I am going to reduce the valuation on it. So tax versus accounting is more of a retention issue. How long is the retention period than it is an issue that relates more to the value based on the nature of the work itself. You know, one of the other things that people always need to think about is, how do we buy out a partner? There are several ways that people tend to buy out their partners. Some will base it on the book of business they own or the book of business they brought in. Some will base it on the book of business they manage. Some will base it on their equity interest in the overall firm. We're a 3-partner firm. I own 25%, therefore I should get a multiple of 25% times the revenue of the firm. Most large firms have switched to compensation-based, where they get paid based on a compensation program. Here's a classic example. They'll look at the last 5 years' income for a partner. They'll take the 3 highest of those years, average it, and multiply that by something between 2 and 3 times, pay that amount over 10 years, typically on a K1, plus capital, a compensation buyout. Then the other type of frequent buyout you see is a hybrid. Maybe some of it's based on the book of business you manage, some of it's based on equity, some sort of hybrid of the above. The smaller the firm, excuse me, it tends to be more equity or book of business based. The larger the firm, the more it tends to be compensation based. There isn't a right or a wrong. We'll hold that for a minute. There isn't a right or a wrong for what's the best way to manage this process. But there are certain parameters that they have to fall in. So again, book of business could be the book of business I brought to the table. It could be the book of business I'm managing. Equity is my ownership interest in the firm, compensation obviously, and hybrids. So before we take a deeper look at it, let's get polling question number 3 in.
Okay, the third polling question is up on your screen now. This one is about the next 5 years. What is your firm most likely to do? And your options here are sell, acquire a smaller firm, merge into a larger firm, or you're not sure. We'll keep it open about 10 more seconds. This is our third of 4 polling questions, and you do need to answer all 4 for the 1.2 CPE credits today. Okay, looks like we have nearly everyone. I'll go ahead and close the poll. You'll see the results there on the screen. We have a fairly even split here. 35% say sell, 30% are unsure, 23% say they're likely to acquire a smaller firm, and the remaining 13% merge into a larger firm.
Wonderful. So obviously most of you are in the game, so to speak. I'm hoping that everybody realizes if I want to buy a firm or sell a firm, the way we value it's the same. These are the simple necessities of how we go about doing business. By the way, I know I'm speaking a little quickly. I'm kind of trying to be a 33 record on 78. If you don't know what that means, don't worry about succession. But I'm trying to leave some room at the end today because I'm putting off the questions that are coming in to address them later. You have those questions, send them in now because I'm going to hopefully have the time to address them. If we run out of time and you have a question, we'll get you an answer over the next couple of days via email. So let's get back to I'm buying out my partners. One of the things that we have to do is we have to come up with the right valuation. Let me share this with you. very recently in a deal in the Philadelphia area, I think it was. Could have been DC, but I think it was Philadelphia. I had a lengthy conversation with a small firm. There were four partners. And they were talking to me about their valuation of how they buy each other out. And it clearly was a very rich buyout. So I asked the managing partner the following question. I said to him, have you ever helped anybody buy a business before? And he laughed. He said, hundreds of our clients over the last 30 years have we helped them make a decision about buying and valuing a business. I said, okay, did you ever tell any of your clients, I just performed due diligence based on the due diligence results that I've come up with and the valuation you're going to pay, you're going to lose money, maybe break even for the next 5 years. It's a fabulous deal. Go do it. Of course not. You would never tell a client, do a deal to lose money. Don't ask your partners to do that. So what we have to do is walk that fine line between making sure the retiring partners paid for their years of sweat equity and the remaining partners make more money. Otherwise, what is their incentive to buy you out if it's not to have a reward? So we need to find that proper financial arrangement. So think of it this way, excuse me. We start with the available capital is going to be the retiring partner's foregone compensation. So let's say I'm a partner in the firm, including perks, benefits, the kid's cell phone, everything. I'm making $300,000. Well, that's the available capital for this buyout arrangement. What do I have to do from that? What I have to figure out is subtract from that what the purchase price is going to be, subtract from that new sum what the cost of replacing that partner's labor is going to be. If what's left is a negative number, we've got a big problem. If what's left is a positive number, then there's a justification for me to do that deal as your successor. So that's what I call the work backwards formula. How much does the partner make? Subtract from that the cost of replacing their labor and their purchase price. What's left has to leave some upside for the remaining partners. So keep in mind, there's lots of ways to accomplish that. Sometimes it's just as simple as taking a 5-year payout and making it 8. It's got to cash flow. So trying to understand the fact that especially for a firm that's looking to bring in young partners, a smart person before they became your partner would want to do what? Look at your ownership agreement. If they realize that when the partners retire, they're going to make less money, they're not going to be motivated to join your firm. So we got to go right into your ownership agreement, and we have to work out an appropriate buyout that leaves some meat left on the bone, but pays you for your years of sweat, so that we can not only keep going and survive as a practice, but we also can be an attractive place for young talent to come in, because young talent is the greatest commodity in accounting right now. Which, by the way, for the small firms, the sole practitioners, 2-partner firms, those of you who think that your succession plan is, I'm going to find a young man or woman to groom to be my successor, good luck with that. That's really more of a pipe dream, I'm sorry to say. I wish I was the bearer of better news. But young talent, such a commodity. The big firms who have 2 and 3 times the succession problems the small firms have are overpaying to get these people. I've been hearing about signing bonuses. It's almost like a baseball player. Crazy, crazy things. And if you have a young person that also has a book of business, oh my, the doors are flying open for them. So we need to come up with the right financial package for a retiring partner. Keep in mind, generally speaking, in internal sales, a couple of things. They almost always go for less. You're not going to charge your partner the same thing you're going to charge a stranger. And there's a lot of reasons for it. A, we were partners. So we're both putting in our sweat. The other thing is, if Nikki and I started a firm 5 years ago and we were doing $1 million and now we're doing $1.5 million and I want to retire, isn't she part of the reason we did that extra $500,000? Should she be paying me a premium on the growth that we did together? So there's a lot of reasons that it usually goes for less. Here's where I have a grave concern for all of you that are multi-partner firms on the line with us today who are small firms. Most of you will have a buyout for your partners that has no retention period. Now, if your firm is brand loyal, clients are coming to you because of your firm in general, okay, I get it. How many 2 to 4 partner firms, clients are brand loyal, around 1%, but 99% are partner loyal. And most small firms don't integrate their partners where every client has 2 or 3 partners that they work with. Most small firms, each partner has their own book of business, their own relationships. How do you go about a deal where I'm going to buy out a partner and pay them fixed dollars day one, even though I've never met most of their clients and most of their clients have never met me? Now, there's ways to mitigate that risk. The strongest way that we recommend is having a 2 or 3 year notification requirement and a transition plan. So if I know I'm going to retire in 3 years, I give my partners notice and we put a plan together that during these 3 years, who are we going to transition each client to? It's very rarely that one person replaces one person. It's more like we're going to leverage this client to this manager, this one to this partner, that one to that partner. We put in a plan and then we enact that plan over the 3 years with a goal that at the end of year 2 or 3, it's a non-event when I retire. The client's already been transitioned. Everything is already happening. It shouldn't matter. So it's very, very important that you either have a retention period in a small firm where the purchase price gets adjusted based on client retention. And if you're not going to have that type of retention period, that you have a transition period. And I usually put in the ownership agreements we help people write and negotiate a penalty if you don't give me that notice. For example, if we require 2 years notice, which is the absolute minimum I would recommend, and I come into you one day and say, hey, I just got an offer I can't refuse and I'm going to take it. I didn't give you 2 years notice, there's a penalty. Some people think the penalty should be a reduction in the buyout. I used to play basketball when I was a kid in Brooklyn, and if there was no blood, there was no foul. So I kind of live like that to a certain degree. So if you don't give me notice and I don't lose a client, I'm not sure I'm going to penalize you. What I usually will use as a penalty is if you don't give me those 2 or 3 years notice, I'm going to get a 2 or 3 year retention period. If fees go down, ratably, I'm going to reduce what we owe you because I'm going to say you didn't put us in a position of strength to retain that client by not giving us notice. Hopefully, we're going to have death and disability covered by insurance. If not, this is going to sound harsh, but nobody gives you 2 years notice before they die, or rarely, I would imagine. So usually that same penalty will apply. You know, I know that sounds horribly harsh, but first of all, most of the time it's covered by insurance, so hopefully it's a non-issue. But I think a lot of people forget the reason that you have an ownership agreement. Some people think that you have an ownership or partnership agreement to protect the partners. I don't agree. I think an ownership or partnership agreement's to protect the firm. If the firm doesn't survive, nobody's getting their buyout. Nothing good's going to happen. So it's critically important that we have something appropriate together. So remember the litmus test we shared. That's the work backwards formula. What does a partner make? Subtract the purchase price, subtract the cost of replacement labor. Make sure you've addressed how AR and WIP's going to get paid out, usually over a period of time. Make sure you've discussed the tax treatment. Is it a K1? Is it a capital gain? Is it a combination? We're going to use 736A1. It's an IRC code that allows in certain situations that you have to have and certain things you have to do post-closing. But the end result is it's ordinary income to the retired partner and still a current deduction to the firm. How are we going to address capital accounts and new partner buy-ins? By the way, my partner, Terry Putney, is one of the experts in the country in ownership agreements, internal succession planning, and admitting new partners. He's teaching a class on it soon, so if you're in that position, go for it. I will share one thing with you. When I have a new partner buy in, sometimes they don't buy into the pre-existing business day one, become a partner in the growth. If Nikki and I are two partners doing $700,000, we want to promote somebody, but they don't have any money, they may not be able to buy into the firm. So maybe we'll say to them, hey, on the first $700,000, you owe nothing. But on the growth after that, you're going to be a 1/3 equity partner. There's lots of tricks to bringing in a new partner. If you have the time available, I'd look at one of Terry's webinars for that. Here's some statistics from the 2012 succession survey. Just 2 days ago, I got the 2016 in detail. I'm about to update these, but unfortunately, I didn't get it in time to make all the changes. But this is some pretty startling stuff. You know, how do you calculate a retirement benefit? Well, look at how many small firms don't even have a concept of how they're going to do that. But what you can see is as you get larger, they tend to start becoming more likely a multiple of salary or compensation. Some of the ones that say other are usually heavily compensation based with a small reward that also has something to do with equity. But the larger the firm, the less equity has become a factor. So keep that in mind. The smaller the firm, usually the more powerful equity is as a factor. The larger firm, the less. Here's what people who are selling their ownership interest to a firm is typically getting when you're basing it on equity. So if I'm a 25% equity partner in the firm, this is how most firms value it. As you could see, very, very few were over 1 time, almost none in almost any category. What I will tell you after looking at the 2016 PCPS survey, the numbers are less now than they were in 2012. So this is a little bit higher than what we're tending to see right now. For those larger firms that are buying out people based on compensation, here was the range. You'll see some listed even as high as 3.5 times, and a couple even higher than that. I will tell you that, again, the numbers became much more higher percentage between 2 and 3 than this case, which was 2.5 to 3.5, where that so many of them were. A couple other things that you need to think about. Again, how you're going to handle AR and WIP. It could be a real daunting task for a successor firm to come in, especially if your receivables are very weak. So if I've got a $600,000 practice and I've got $200,000 in receivables, it's very likely the successor firm might ask you for the use of those receivables with a payback period. I don't want to confuse anybody here. When it comes to accounts receivable, if I'm selling my practice, whatever receivables are, they're my money. That's not the question. Very rarely does a buyer buy receivables. I think I've seen that twice in the last 20 years. However, sometimes the buyer will ask the seller for a payout period on those receivables because they might be having to put themselves in a position of coming up with a lot of cash, integration of the practice, relocation of the practice, all of the technology aspects of it. If you're keeping most of the AR on WIP, again, there could be months before they start getting cash flow on their business. These things have a big impact. People are going to look at the cash flow of what's going to come in shortly after I buy the practice. If I'm taking over the practice at a low cash flow point of view, I might be seeking either no down payment or use of some of the receivables or a combination thereof. A lot of people will take a look at whether you're doing value billing, time and billing, retainers. So these are all part of the profitability of things. An interesting factor is, as I alluded to earlier, the larger the firm tends to be a lower multiple and longer payout period. Shouldn't be a surprise. First of all, we use the word sell and merge interchangeably, and they're not interchangeable, right? It's very rare a $10 million firm sells. What's very likely is a $10 million firm has some partners selling, some partners merging. A merger means I'm exchanging equity in my firm for equity in your firm. A sale means I have no equity. How many times is a big firm just bought? Most of the time it's merged with some being bought. But if I'm a $10 million firm, I'm 1/3 labor, 1/3 overhead, 1/3 profit. A sole practitioner might have 40, 50, 60% profit. So multiples tend to be higher for smaller firms. Payout periods seem to be shorter. Remember, when you're doing your homework, look at what billing rates and profit means to you. And keep in mind, culture is very hard. Some cultures are very hard to mix. For example, bigger isn't always better. Better is better. If I have a small firm and I'm doing a voluminous amount of hand-holding and I've got $5,000 a year clients, do you think if I sell it to a big firm, they're going to have a partner handle that $5,000 a year client and do all the hand-holding I do? Bigger is better most of the time, not always. Right? You have to look at culture from an IT perspective, from what the clients think. Terry, my Putney, had a great way to describe culture that you always want a partner smarter than you. I have a partner smarter than me. Terry always says that when I try and define culture, because there's so many definitions of culture, I look at it from 3 perspectives. What's it like to be a partner in that firm? What's it like to be a client in that firm? What's it like to be a staff person? These cultural aspects are really important. There are some things you can do to make your practice more attractive. Embrace technology. A lot of firms don't care what software you're using, but are you on the cloud? Are you paperless? Anything you could do to make your clients more brand loyal and less partner loyal will help the value of your practice, help the retention of your practice. And that could simply be that clients are accustomed to working directly with other partners or staff. Have a good understanding of what your firm's metrics are. I got to tell you something. I had someone this morning that I was speaking to, and I said to them, tell me about your practice. How, they told me the gross. I said, what do you think your net is? He said, whatever's left. Not a good answer. You should know. I bet you anything this accountant has impeccable records for their clients and has very poor records of his own. You need to have a good understanding of your metrics so that when you speak to a firm, you could speak accurately. Nothing makes you look more silly than sharing information that doesn't turn out to be correct. Whether it's a merger or acquisition, always remember the golden rule of the 4 C's. First one's chemistry. If you don't want to eat lunch with someone, don't do a deal with them. Clients have choices of what accounting firms to go to. Staff have choices. They go someplace where they're comfortable. Remember, your clients don't know you're competent. If they did, why are they paying you to do the work they could have done themselves unless there's an audit involved? They're with you because of their comfort level with you. That's why another important thing is continuity. If someone's going to take over your practice and make wholesale changes, is that going to impact your retention negatively? Probably. Think of change, by the way, in 2 ways, behind the door and in front of the door. Change in front of the door is like I'm changing from visiting you quarterly to staff coming to see you and putting you on the cloud and blah, blah, blah. Change behind the door is I was using Lacert, now we're going to use CCH. Nobody cares. Change in front of the door, you got to do slowly. You got to look at the culture, as I described the Terry handles. And I think something that people don't look at enough is capacity. If I'm selling my practice, do you have the capacity on a partner level as well as the skill set to replace me? Because if your plan is no, don't worry about it, but I'm going to hire more people, good luck. I mean, you can, but if as a seller, I don't want to count on you finding the diamond in the rough. Remember, a good deal's a fair deal. Seller has to be paid for their years of sweat equity. The buyer has to make a profit. And it's a package. Just don't look at things individually. Put the whole package together and do what you can to make your practice better. Hey, great talent, well-trained staff, well-trained clients. Those are just some of the examples that could help you make your practice better. Page we're looking at right now is a page that the PCPS division of the AICPA has called Succession Planning Resource Center. Fabulous tools. When should you start to plan your succession? How do you choose a successor? Great, great stuff. If you're a member of the AICPA, PCPS, take advantage of it, whether you're a buyer, a seller, a merging, or merger. Fabulous, fabulous information. But I know we only have, I guess, 2 minutes left, and we have some closing business. Do I have time to address any questions? Oh, we have to do our next polling question. Let's get that done first.
Sure. I'll go ahead and put the polling question on the screen, and then while everybody's answering that, maybe you could answer a question or two.
Sure.
The polling question is how many partners in your firm will likely slow down over the next 5 years? So we'll let everyone answer that. We had a question that just came in a 2-partner firm with a 25% partner buying out a 75% partner. In addition to the percent of fees, should we consider AR in the value equation? And if so, how?
Yeah, what normally happens is you have your intangible and your tangible assets when you sell an accounting firm. The intangible is what most of the time we refer to for the multiple. That's really the goodwill, the client list, things like that. AR and WIP is almost always in addition to that. Now, part of that's a valuation question. Because, for example, I had a firm that has a very high multiple. They're buying out partners at 3 times comp, but they get nothing for capital, which is kind of the same, by the way, as 2.5 times plus capital. So it has to be figured in, but it still has to cash flow. So yes, if you're a 75% equity owner and you've been sharing compensation in that way, 75-25, then you own 75% of the AR. The question is, when do you get it? So if your payout period is 6 years, you might have to take a 3-year payout on the AR WIP. Remember something talked about before, the litmus test. It's got to cash flow. So we need the next person needs time to be able to replace that money in a gradual way. So most of the time, a purchase price will not include AR and WIP. Sometimes the purchase price is exaggerated a little bit, and as a result, it will include AR and WIP. But each deal is kind of unique. For example, in that same firm, when I became a partner, did I have to invest capital? Well, also, for example, I've had firms where one person owns 75, the other 25, but they've been acting as equal partners in compensation. Now, all of a sudden, we've been making the same money, but now you want to tell me you own 75% of the AR WIP. So there's mitigating factors all over the place, but generally speaking, AR and WIP is not part of a multiple. AR and WIP is a separate item that should be reimbursed, typically with a payout period. I know we're at 3 o'clock. Are there any other quick questions I could address, or do I need to take care of the rest of them through email, boss?
I think we'll do the rest by email. Joel, if you want to pull up the last slide, that has Joel's contact information on it. I'll go ahead and end the webinar here in just a moment because, as you recall from earlier, the survey will pop up once the webinar ends, and I want to make sure everyone has a chance to do that since that's one of the CPE requirements. So if you have any questions about content, feel free to reach out to Joel directly. He's got his contact information there. If you have any questions at all about your CPE, you can reply to the messages that you've gotten from GoToWebinar. That'll come to me. Otherwise, you'll just receive your CPE certificate within 10 business days after you meet the requirements. With that, I think we'll go ahead and end. Joel, thanks so much. Thank you, everyone, for attending, and I hope everyone has a great day.
Thank you very much, Nikki. Thank you all.